Imagine getting paid every single month from stocks, gold, or the S&P 500 without selling a single share. Sounds perfect, right? That's exactly what options-based ETFs promise. And that's why billions of dollars are pouring into them right now. But here's the problem. Most investors have no idea how these funds actually work, or what they're giving up to get that income. If you've heard names like JEPI, QYLD, or funds using covered calls and zero DTE options and felt completely lost, this video will make everything click. By the end, you'll understand what options-based ETFs really are, how they generate income, why some are brilliant, and others quietly destroy your capital. And the biggest mistake beginners make when chasing high yields. Let's break it down simply. First, what is a normal ETF? An ETF is just a basket of assets you can buy in one click. SPY owns the 500 biggest US companies. QQQ owns the top tech stocks. GLD tracks the price of gold. When those assets go up, your ETF goes up. When they go down, your ETF goes down. Simple. Now, options-based ETFs add a second layer. They still own those same assets, but on top of that, they sell options contracts on them to generate extra income. Think of it like owning an apartment building. The rent from tenants is your normal return. But now you also rent out the parking spaces, the rooftop, and the billboard on the side of the building. Same property, more income streams. That extra rent comes from options. So what is an option in plain English? An option is a contract that gives someone the right, but not the obligation, to buy or sell an asset at a fixed price before a certain date. When you sell that right, they pay you a fee. That fee is called a premium. And that premium is the income these ETFs distribute to you. You're basically getting paid for renting out your assets. Now, there are two main ways options-based ETFs do this. The first, and most common, is covered calls. Here's how it works. The fund already owns the stock or ETF, like SPY, QQQ, or GLD. It then sells someone the right to buy that asset at a higher price. If the price stays below that level, the option expires worthless. The fund keeps the premium. If the price shoots above that level, the buyer can take the asset at that fixed price, which means your upside is capped. You get income, but you give up explosive growth. The second strategy is selling puts. Instead of owning the asset, the fund sells someone the right to sell it to them at a lower price. They collect a premium for waiting. If the market drops, they buy at a discount. If it doesn't, they keep the premium and repeat. So one strategy earns income by capping upside. The other earns income by getting paid to buy dips. Now let's make this real with examples. Take a gold income ETF that sells covered calls. Normally, gold pays no income at all. You just hope the price rises. But with a covered call strategy, the fund owns gold exposure and sells call options every week. Those option premiums are collected and paid out monthly to investors. Result, you still get gold exposure. You still benefit if gold rises moderately. And now you also get monthly income. But if gold explodes in a massive bull run, your gains are capped. That's the trade-off. Now look at a more aggressive example using the S&P 500 and something called zero DTE options. Zero DTE means 0 days to expiration. Options that expire the same day they're sold. Maximum premium. Maximum risk. Some ETFs sell these every single trading day. If the market stays below the strike price, the option expires worthless, and the fund keeps the premium. Do that consistently, and you can generate very high monthly income. When it's executed well, you can actually get strong total returns plus double-digit yields. When it's executed poorly, you get something far worse, NAV decay. And this is the silent killer of options-based ETFs. NAV is the actual value of the assets inside the fund. If your ETF pays you 15% a year, but its NAV drops 20%, you didn't make income. You just slowly sold your own portfolio back to yourself. This is why high yield can be a trap. A 40% yield means nothing if your capital is bleeding underneath. That's why you never judge these funds by yield alone. You judge them by total return and NAV stability. Now let's talk about the main types of options ETFs you'll see. Monthly option sellers, more conservative, lower yield, more stable. Weekly option sellers, more income, more active management. Daily or zero DTE option sellers, highest income potential and highest execution risk. Some use covered calls, some use put selling, some mix both. And this is where investors get into trouble. They see a huge yield number, they ignore the strategy, they ignore the NAV, and they end up in what's called a yield trap. Here's what that looks like. You invest $100,000 into a fund yielding 35%. You receive $35,000 in distributions over the year. Feels amazing. But your investment value drops to $75,000. Your income just came from your own capital. You worked all year for a net loss. This happens all the time with poorly designed options ETFs. So how do you avoid that? You focus on 5 things. First, are you bullish on the underlying asset? If you don't believe in tech, don't buy a NASDAQ options ETF. Second, is the NAV stable compared to the benchmark? If it's consistently lagging and eroding, walk away. Third, what's the total return? Not just income, price plus distributions. Fourth, is the yield reasonable? Above 40% is usually a red flag. Fifth, is the strategy logical? Daily, weekly, monthly? Out of the money or at the money? Risk management matters. When you apply this framework, you quickly see the difference between well-run funds and income traps. And this leads to the big question, who are options-based ETFs actually for? They're great for income-focused investors, people near or in retirement, those who want monthly cash flow, portfolios that need diversification, sideways or choppy markets. They are not ideal for pure growth investors, people who don't understand options, anyone chasing yield blindly, portfolios that are 100% income-focused, strong bull markets where capped upside hurts you. The key is understanding that these are tools, not magic. Used correctly, they can smooth volatility, generate consistent income, improve risk-adjusted returns, turn non-yielding assets into cash flow machines. Used incorrectly, they cap your upside, destroy your NAV, underperform simple index funds, lull you into a false sense of safety. So here's the bottom line. Options-based ETFs are not good or bad by default. They are strategies. And strategies only work when you understand what's being sold, what's being capped, what risks you're taking, and what you're giving up for that income. Never chase yield. Always watch NAV. Focus on total return. Understand the options strategy. And treat these funds as part of a diversified portfolio, not the whole thing. If you master that, options-based ETFs can become one of the most powerful income tools in modern investing. And if you don't, they become one of the most expensive lessons you'll ever learn.